Hello, hello. You're listening to Paradigm Shift, a podcast about people building the future and pivotal moments in their journey. I'm Ashish, and I'm joined by my co-host Zane. And today we're excited to speak with Alanna Gregory, who runs engagement and retention at Afterpay. She's also an active angel investor and former founder.
And I just want to say I'm really excited to have Alanna on because we've done some investing together, and she has such a great, unique perspective on fintech, having spent time on Wall Street, done a startup, done a bunch of investing and consulting work, and now leading growth and engagement at Afterpay. So welcome, Alanna. Great to have you on.
Thank you. I'm so excited to be on. Thanks for having me.
Awesome. So we definitely want to talk about, I'd say, like three big things. So maybe we can talk a little bit about your Wall Street experience and how that sort of shaped your thinking. And we can talk a little bit about your startup journey. I'm sure there's a lot to cover there. And then finally, it'd be great to talk about how you ended up at Afterpay and your thoughts on fintech and some of what's exciting and some of the risks in the market right now. How does that sound?
Sounds great.
So starting at the top with your Wall Street experience, tell us a little bit about that. What was that like? It sounds like a crazy time, right? Lehman fell. I know my friends graduating who were going into Wall Street had a really hard time then. So what was that like for you? And help us get a sense of that moment in time.
Oh, it was dark and wild when Lehman fell. And I was actually supposed to work at Lehman on the mortgage pass-throughs trading desk, which obviously I didn't get to do. So I ended up, because of my background in algorithmic trading or electronic trading, wasn't for me. So I ended up moving into fixed income research, specifically for emerging markets. We had layoffs every year, but I think it was also a really exciting time because there was so much opportunity. And so there had been this huge upswing in US markets, whether both debt and equity. And, after 2008, I ended up in emerging markets in 2009, that's when there was sort of this blossoming. Everyone was really interested in China and the BRICS for the first time and emerging market debt. And so that was like one sort of growing and highly volatile but exciting space. And then the second was electronic trading, which I had a very brief stint in, but this was new. This was like way before Flash Boys. And you saw for the first time, markets used to be made by a person, like not a machine. And so someone would be on the other side buying and selling. That person would have an understanding of liquidity. And it was the first time you could create algorithms to execute trades automatically or source liquidity via a dark pool without someone noticing on the other side. A dark pool is essentially, you don't know, like it was really great for block trades. So I think even though there was a huge pullback, a recalibration of compensation, it was still, I think, a really exciting time because there was so much newness happening.
You ended up spending 4.5 years at Barclays, right? That's a solid amount of time. So, and now you've been in tech. How do you think about the contrast in cultures, and what was it like working in the financial trading and equity research kind of job? How do you explain it to people who've never been in that environment?
Yeah, it's a great question. So I think the best way to explain the job is structure, because your job, your start time and your finish time are governed by markets, right? So like the market opens, it means you have to be on. And so in that, there's an implied rigidity, which can be great, but can also be tough for people who are creative or have different, maybe aren't morning people, and so your job revolves around markets. And that's the thing, the market also, even if it's your region, like the New York Stock Exchange, like the markets are always on because there's some region, whether it's Asia or Europe. So you'd always have those early indications. So I think it's actually very fast paced, very rigid, but a lot of really smart people. So that was sort of the culture, whereas tech is much more fluid. If you see a problem, something doesn't exist, you can start it. You can create your own hours depending on where you work. So that to me was the biggest contrast. And it was actually really tough to make the adjustment at first, to go from something naturally so structured to something much more unstructured.
So that's actually a great segue, because after 4+ years at Barclays, you went on to start a company. What drew you to that? And maybe you can provide some context on what the company did as well.
Yeah, so I ended up starting a company called VIVE. It originally was a kind of like a glam squad or like an Uber for beauty, right? Like you'd get a blowout in your home. That was the initial idea. But as far as what got me to that place, 2013 was a really interesting time. Markets were tough and we still had scars from the Great Recession, but you started to see this flourishing in New York that had never really been around. So like, the early days I remember when Betterment launched or Blue Apron, for example, and those have become really large and successful companies. So I became interested in this idea of building something. Like I was starting to build out coverage of certain spaces, but it didn't feel very tangible to me. And so I was really always fascinated by marketplaces, I think because I operated in financial markets. And so this idea of supply and demand with like underlying data that could point you one way or the other. So I spent a lot of time just like studying marketplaces. And I ended up being interested in the beauty marketplace because it seemed, it was really large. There was a lot of local, there was an emphasis on your location, which seemed interesting to me. And there were so many small businesses, which are obviously very different from being at a structured bank.
So VIVE was kind of the subscription marketplace product, right? To book your appointments. And I think your merchants would pay a subscription fee, which would help them get more customers. It's a model that's worked, right? It's actually like kind of a model that I think was slow to take off and it was like a tough model to crack. But two things jump out at me. One, I think it was kind of the right idea, maybe not the right time. And it did kind of work eventually with like MindBody and a few other products. Even today, there's a product called Spire that does that for like, I think barbershops, it's doing pretty well. And the other is, I think New York City is a great place to build that kind of product because it's this sort of like, it's so much density, right? Foursquare started there and there's a bunch of like food delivery things that took off early on. So tell us about that journey a little bit.
So I had this idea and started working on it in after hours. And by the time I left, one of my first bosses from electronic trading wrote me my first angel check, a guy named Bill Bell. So I guess that was like my first it gave me the confidence to leave. And I also had a friend who was at Etsy at the time, who was an engineer, and he was pretty interested in it. He thought there were some legs. And so it was the two of us and then my hairdresser, actually. And so the three of us sort of embarked.
That's a good sign, by the way.
Yeah. Who had been like my friend and hairdresser for like 10 years. So it was the three of us kind of embarking on this journey. And so PJ was he's the engineer. He was building the tech. I was sort of doing, everything like product related and growth. So it didn't have a name at the time. Like we didn't call it that. And then Kristen, my hairdresser and another co-founder, was working on acquiring stylists and like training them. And so that was our marketplace. And then we realized pretty quickly that this is a very tough model. The unit economics didn't necessarily work out because you can acquire a customer, the cost of customer acquisition is high. It was introducing a new behavior. So still a lot of behavior change, which I think is ultimately maybe why that was too early. And then, just quality, like people assumed a certain type of quality that wasn't necessarily achievable at home. And so we decided to pivot into the salon space because majority of customers were still going to salons, is what we learned, and preferred salons, but salons were struggling with their customers. They would have downtimes. They still had to pay rent. They had to pay fixed rates to their staff on the downtimes. And so, we thought we could develop a solution to that, which is how we landed on the model. And it was, like I said, New York was still really young, like it was in its startup scene. So we were able to meet a lot of other founders who were at a similar stage. And it was a really like warm and like exciting time to be in tech in New York because it was really at its infant stages. And so it caught on pretty quickly. We spun up like a basic MVP. We had 100 customers, I think, within like a week. And it kind of blew up from there with our first offering, which was like unlimited blowouts for $99. I think we had a 14,000 person wait list in like 6 weeks that we just couldn't handle.
That's amazing. So like, that sounds like really good market demand and early traction.
The unit economics were really tough. Unit economics of the business are really difficult. So
$99 for unlimited blowouts. That sounds like people loved that and wanted that.
So we actually had a really nice margin, it's essentially an arb or an arbitrage, right? So you're offering someone a subscription, you're taking a bet on how many times they're going to use it, and you have a certain cost associated, right? And so it's like a gym membership. And ultimately, I think that type of model is not great for the user because they're not getting, like, you're making money by them not.
If everyone uses it to the max, like, it doesn't work. So yeah.
Exactly. And so we evolved into more of a credit system, which is what ClassPass is now. And we never saw the same, pickup on the credit system on the demand side as we did for Unlimited. I think there was something novel there. Plus the frequency changed. Like, we were actually changing consumer behavior when we offered unlimited blowouts and unlimited services versus when you have to pay per service, customer behavior shifts back to what it normally is. And so, we were still making money. We were still driving purchases, still the ecosystem was working, but yes, unit economics were difficult. And when you change the frequency back to what it normally is, it's not like ordering takeout or ordering in a cab or transportation. Like, you're doing it once a week, a couple times a month. Like, that looks very different as a business than ride sharing.
I feel like there's like a school of thought, which is, as long as you're close enough and you have a path to make it work, grow, and then, like, with more data, like, optimize the packaging. How do you think about that? Do you think, do you wish you could have done some of this back then? Or was it just like, were you just not able to, like, raise the capital to have that kind of strategy?
That was our intention, right? Was to just acquire customers, have margins basically be razor thin, and continue acquiring customers, adding in more services to extend the LTV of the customer. But yeah, we couldn't raise the capital. Like, I think at the time we were going out to raise, like, our Series A. 2 businesses had just folded in the space, one in Chicago that I think Lightspeed had backed, and another one in New York. And I think investors were kind of spooked and wanted to sit out on the sidelines for a little while. So at that point, I decided, look, if we can't get the capital to grow, and it's not worth it to just ride out this company and run a profitable business. So
I'm sure you think back on those days. There's some things you wish you'd tried or tested. Like, it's like, oh, I wish we just tried that one or two other things. Do you have things like that you sometimes ponder?
Towards the very end, we were trying to save the business, and so we wanted to go more of like a SaaS play and develop software for the individual hairdressers, because we thought that kind of what you're seeing now with, like, the rise in freelancers, we knew that hairdressers were going independent more and more. And so we wanted to essentially be like Squire, but for independent hairdressers. So that was one train of thought. And then another was really to go into products, like physical shampoo, conditioner products, and use hairdressers as a sales outlet. But our investors, one of my investors, I'll never forget, she was like, Alanna, you know how to build software and tech products. You do not know how to build physical products. So I suggest you leave this to someone else. It was good advice. Yeah, I think I'm amazed at what we were able to accomplish given the industry. I think I did a pretty bad job picking an industry. And so if I were to do it all over again, I'd probably look at the space and the unit economics and understand the mechanics of how you make money. And I actually think it's important to think about that in the early days because it impacts your ability to grow. Because product market fit isn't just about getting demand. It's about getting demand in a scalable way.
So finally, you end up back in Fintech, right? So tell us about that. Like, what led you to Afterpay? And then let's talk a little bit about what we're seeing in Fintech today.
So I knew I wanted to go back into Fintech. And Afterpay reached out to me and with this opportunity to build out the owned and operated channels. And so I was excited for sure. And also too, I thought I was really looking for a company at the early phase of its S-curve, with a lot of room to grow. And I was like, if I'm a growth marketer and 5 years ago, Instagram would have been the coolest place to be, what is that place now? And so that's kind of what I was looking for. And I thought BNPL had a ton of room to grow. There was still relatively low awareness and they were an early player in the category. My concerns were obviously the compression of margins, stuff you see with Uber and Lyft, but I was still really excited and thought I'd learn a ton. And so that's how I ended up there.
Afterpay is an interesting business because you have two types of customers. Maybe just set the context for listeners who may not be familiar with it. Do you mind describing what the business does and how it interacts with these two groups?
Yeah. So Afterpay is a buy now, pay later company. That's the core offering, meaning you've probably seen it at checkout, where when you're on a website and you have something in your cart and you get to the cart, you can select Afterpay as a payment method to spread your purchase over 4 equal payments. In addition to being at every merchant checkout, we also have an app where you can see, we call it our shop, and you can see all of the tens of thousands of merchants that carry Afterpay, and you can go to the shop. The goal is really to inspire customers to shop via good content, and you can discover new merchants and then click out and then eventually purchase. So their shop actually accounts for a good chunk of our daily and monthly GMV, which is the transaction value we look at.
So what does leading engagement and retention at Afterpay look like? What are some of the channels, and how do you guys think about your key levers?
Yeah, so we've been building them, which is kind of fun. So immediately, obviously we have email and push from a channel perspective, and then our app. And I joined maybe 2 months before we started to monetize. So we started to introduce ads and affiliates. So meaning that Afterpay is becoming a publisher. So every time we send traffic to a merchant, we can monetize that traffic. And one of the really exciting things that I'm getting to build out is really like the publishing arm of that. And so how we get to storytell to drive revenue, both from a sponsored perspective and like just an editorial perspective, all towards driving revenue. So it's almost like a mini media company, which is really cool. I've never had exposure to that before.
Yeah, that's awesome. And how do you balance like the focus on the consumer versus the merchant? I assume maybe the merchant is sales driven, or maybe some of that self-serve now. Like, what's sort of the balance there?
No, I think people, so first of all, like I always try and think about what is the value that we're adding to our customers. And I think one of those is as an aggregator. And so the merchant is really central to all our communications and which merchant we feature, because each merchant has different value to us also as Afterpay, right? Like each merchant brings in a certain amount of new customers, or certain merchants, other merchants are more efficient, right? So for their conversion rate, so say we send 1,000 emails with a merchant, merchant A, merchant B, there's going to be a difference in performance. And so I think they're actually really integral into our consumer strategy. And it's something like it's a muscle actually that we're developing. Like because they're essentially our product. How do we merchandise our merchant offering? And so it's been actually really fun to think about. And different merchants resonate obviously with different customer profiles, different risk profiles. Merchants have in and of themselves, their customers have different risk profiles, which means something different for Afterpay. So I think they're really, really connected. We have to care just as much about the merchant as we do the consumer.
What's the long-term strategy behind having the standalone app? Like, why do that at all versus just focusing on supporting merchants?
So the app is ultimately what makes us a marketplace. It's a place where consumers can come and discover. And so it provides a couple of things. One, added value for that shopping and discovery. And a large chunk of our customers who use the app do it for shopping and seeing content to engage with. And, we have product collections and shoppable content and videos. It's almost like a feed. And then, of course, you can use it to keep track of your payments. And the third piece is probably loyalty. We have a rewards program where you can actually earn points and offers by making payments on time. So in terms of the app, like why that versus just, at checkout, I think it's really to provide value to the customer.
Right. Yeah, that makes complete sense. Shifting gears a bit, this is a very unique time for fintech. And I know you do a lot of investing and there's a lot of excitement and optimism. At a high level, what are you seeing in the fintech space more broadly? What excites you? What maybe concerns you about it?
I think there is a lot of excitement around fintech. I think because it's now with so many APIs, it's a lot easier to spin up an offering. And I think as far as the things that concern me, similar to Afterpay, where there's some inherent, like you're buying something and you're paying it later. I've seen that type of model apply to lots of different industries. And so whether it's like a landlord's rent or an Etsy or like a Depop store owner and like getting advances for their future sales, like essentially everything now is getting levered. And I've, no matter, or in construction, like if you're a commercial like contractor. And so I think that element of risk and leverage is slightly concerning because, what does that look like a year, 2 years from now? Does it create an unsustainability? At some point, there are defaults, and the markets have seen that before. So is it another debt cycle that kind of gets run up by the free flow of cash?
So just to double click on the system potentially taking on too much risk angle. So if I'm a startup, right, and I want to build the landlord example you referenced, where I want to let my customers pay their security deposit in installments, for example, how would I approach that? Like, how do these founders underwrite that, right? Just generally, how do you go about getting access to the capital to provide it with no interest or low interest for that type of scenario?
In the beginning, companies are lending off balance sheet, which is always a bit worrisome. So they'll raise capital and they'll use that capital to finance loans as a way to prove concept, right? So at some point, you have to be able to build a model that can figure out how to tell you how to underwrite and then use that as a way into a credit facility.
Yeah.
But in the early days, most of the founders I've met are, using money to, like, they're raising money to then lend. And I think being able, a company has gotten to a point where they've started to figure things out if they're able to get a debt facility and like the size and quality of that debt facility and the interest and like the cost of capital.
Yeah. And so where does it start to potentially go wrong? Is it when you start doing that type of model on longer time horizons where, if it's like 4 installments in 4 weeks, maybe you can, there's a quick enough feedback loop where you can react to screw ups in your underwriting. But I'm sure startups have tried longer time horizons too. And if you were doing one of these companies, where would you try to manage the risk or where would you try to be really careful?
So I think there are 2 components. One is the counterparty risk, right? So if, for example, like payroll advances, if I'm going B2B and I am only acquiring like consumers who I'm lending to, like, there's some stability to the counterparty. So I think that's the first part is the counterparty risk. And second is collateral, right? Like, is there collateral in the transaction? And what is collateralizing it? So is it a company's revenue? Is it a piece of property? No, because that's a mortgage. Like, is there inventory? And what is the value of that collateral? And like, how liquid is it?
Yeah, I think that's a good segue into DeFi because with DeFi, I think it's all of these concepts on the next level, like programmatic and, algorithmic instant settlement and everything collateralized on, highly volatile assets. So before we get into that, just at a high level, what's exciting about DeFi to you? And what do you think is the core innovation? And
a couple things, like the potential transparency of markets is exciting, right? So a lot of particularly complex like debt markets, there's a lot of opacity, right? And as a result, it's slow. And so if you have something that is faster and more transparent, I think that in and of itself is an innovation.
What do you see as the future of DeFi and crypto? It's really exciting right now, but there's maybe like a couple 100,000 people actively engaging with wallets. There's a few million who are sort of doing something more than actively trading in that world. What do you think happens in 3 years, 5 years?
I think as far as, where it's going, I think it's going to become much more mainstream, particularly at some point, I'm sure, like it's already happening. Like banks are building desks, not like hedge funds already have them, but like banks will be building crypto desks. And so there'll be the institutionalization of an asset, but I think it's going to be, again, like just like stocks or bonds, like this diversification, and you have a portfolio of different types of coins, whether they're primary protocols or like storage or, telecom or DeFi or NFTs. And so you're going to see the development of like more and more asset classes and diversification across the asset classes, which is exciting. And this institutionalization. And with that, like you'll probably see other things. Like I think I mentioned, like whether it's like crypto insurance for wallets, or I just think it'll become And I think it'll happen quickly. In NFTs, I actually think NFTs are the next like frontier for marketing. We just don't have a platform yet for NFTs, but I think brands, like, they're already thinking about their NFT strategy and what it looks like. I think you'll have agencies that help brands develop their NFT strategies. You'll be able to, like, NFTs and commerce, so I think will kind of merge, and they'll become this marketing vehicle to build loyalty, to build community, to build transparency. And I think it's going to happen fast. And like at some point, once there's a platform like a Facebook, like, it'll really accelerate. So I'm excited personally. I think there's a lot that's going to happen. So
that's great. We're living in a unique time in that there's been unprecedentedly low interest rates for a long period of time. I'm curious to get your thoughts on what you expect will happen if interest rates go up. If you're giving advice to founders, what you think they should do to navigate this environment and protect themselves from any risks.
So my dad likes to say this, and anytime like things are falling, there's always opportunity, but you have to know how to look for it. And so even if markets, let's say, tank, it's going to create opportunity. You just have to know where to look for it, right? So let's say, interest rates do go up, there's a pullback, and what does that mean? And, default rates for all these highly levered assets type start to go up. Yeah, I do think there'll be opportunities. Do I know what those are? No, or else I'd probably start a company myself doing that. But I would just say, like, don't view volatility or downfalls as like the end of the world. Just like think about what the opportunity is on the other side. So in the debt example, like I said, maybe it's debt collection. That's like one example. Like if it means that there is tightening from a labor perspective, if they're like over the last year, a lot of people have become, solopreneurs or freelancers. Like, do we start to see a movement back towards companies, or do we start to see like, the flourishing of more entrepreneurship? So yeah, I think it'll be interesting, and, you just have to know where to look.
It reminds me of the old phrase, don't let a crisis go to waste. I like that.
Oh my God. Yeah. It's like the best one, right? It's so true.
We ask every guest 3 questions at the end of each interview. And the first one is around superpowers. So everyone has something that they're eerily good at, something that feels like play to them, but work to others. I'm curious to hear from you, like, what are some strengths and superpowers that you've noticed in yourself that you like to lean in on, both, when you're operating and investing?
So on the operating side, it's hiring and spotting talent, but it plays nicely into early stage investing because it's about spotting talent and talented founders. I'd like to get better at it. I always think I can. And then I think just understanding how to like ask the questions to get to the heart of like how to really pick something apart and like understand the drivers.
The second questions are on people that have given you a break. Are there times in your career where you feel like particular people have really opened up doors for you or gone to bat for you that you're, particularly grateful for?
Oh my God, so many. My second boss, first and second boss on Wall Street, like my first one who wrote me the angel check, and then my second one who basically like helped me become an analyst and like took a gamble on me. And then when I was starting a company, a guy named Alex Tao, who was another founder, just like really opened a ton of doors for me. And Semel Shah also was like one of my first investors, helped me a ton. And Pascal Levy as well, like really early supporter. So yeah, I would say those are some. And then even too, when I was consulting, like there were some founders who were like, hey, I think you're good at this thing. I want you to help me. There are a few of those.
And the last question is around books. Are there any particularly impactful or memorable books that you've read recently?
Actually, I read the book about Netflix and their culture. I think it was No Rules Rules. I thought it was awesome, like totally aligned with my values and how to run and build a company. Like it seems like a really exciting place. So I thought that was a good one recently.
I know we have a lot of founders listening to this podcast. So are there particular things that you took away from that book that, that resonate with you?
So many. I think like how to set an example for your team, how to like the emphasis on speed. Like I think centralized knowledge, decentralized decision-making, there's a lot in there that's really good. Also like compensating and like having a really high bar for talent and like paying those people for it. because they're valuable. And like ultimately people are your company.
Alanna, this has been really great. Thanks so much for coming on and sharing your insights. We really enjoyed the conversation and we hope to have you on sometime again in the future.
Cool. Thanks. It was really fun talking to you guys.
Yeah, likewise.